Hello, good day to you all watching. My name is Inshira and welcome to the Premium ICA lecture videos, and welcome to our videos today on the overview of financial management, or what we can call the fundamentals in corporate finance. In this video, I'll be discussing with you the four major decisions of the financial manager and give you an overview of the entire ICA syllabus, and then tell you what we are going to be doing and what we are going to expect over the life of these series of videos that we will be doing on financial management. My objective in this video, as I said earlier, is just to introduce you to the entire idea about the financial or the job of the financial manager, and it is my objective that at the end of the day we will be able to have an overview, have an idea, have a word, or the entire views of financial management in our palm that we can hold upon it, and as we begin to roll out the topics one after the other, we will just bring it together, bring the pieces together, and then understand the entire thing and enable you to prepare for the exam and excel and pass very well. Alright, so I know that you would ask me what is financial management. Basically, let me first talk about the structure of your examination. The examiner is going to set 5 questions at the level 2 ICA exams, where you are not going to have any options, so you're going to be answering all the 5 questions. The ratio on proportion in relation to the theories and calculation aspects will be somewhere between 75-25 or 80-20, depending on the objective of the examiner. But don't worry, when it is exam time, we here at Premium Education Hub will help you to provide you with the examination analysis documents prepared by our industrial expert examination committee, and we will publish it, make it available to anybody that requests for it. And once you make that available, in each examination sitting, we will help you to know, narrow down your studies, look at where you focus on, so that you prepare adequately well for the exam. But in the exam, the examiner is going to test you on various aspects of the syllabus. The syllabus is divided into a couple of divisions, but we here at Premium have divided them to a couple of divisions here at Premium. The first division of the syllabus, we decided to call it the introduction, or if you want, the overview. The introduction, or if you want, the overview. That's the first thing. Then from there we come to what we call the main topics. Under the main topics, we will be spending enough time on investment appraisal, we will be working at sources of finance, we will be working at cost of capital, we will work at business valuation, we will discuss about working capital management, then we will end those series on risks management, that is currency risks and interest risks management, and then finally we will go back and deal with some introductory theories. Introductory theories. Introductory theories. So these are what we talk about here at Premium, how we have divided our syllabus. So here at Premium, we divide the syllabus into 1, 2, 3 sessions, and the videos we are going to be doing, we're going to come in 3 different sessions. In the first session, as you're watching now, we're going to deal with the overview of the entire financial management syllabus, and then in the second session, we are going to take the topics one after the other, and then in the final session, we will do what we call the introductory theories, that is some theories in relation to financial management market. We will talk about issues in relation to government and the effect of government policies on businesses. We will talk about exchange rates. We will talk about inflation. We will talk about taxation. So government activities on the success of businesses are what we're going to be talking about in that series. So here at Premium, we divide the entire financial management syllabus into three major series, and in these three major series, we will be dealing with these three things, and it is our objective that at the end of the series, you'll be able to not only understand the concept, but you'll be able to solve more questions on your own, prepare yourself adequately, and our objective mainly is not really to make you pass the exam alone, but is to put into you a certain knowledge, impact into you a certain level of knowledge, so that when you get to the work field, you can be able to practice these things that you learned in class, so that it will become very meaningful to you. Because a lot of the time people learn for only the exam, but we here at Premium are not interested mainly in the exam, even though that is also our focus. We are also interested in the aftermath, that is after writing the exam, after excelling, after becoming a chartered accountant, what happens to you? How do you practice the things that you have learned? These are what we look at as a business here at Premium. So these are the overview, or these are the ways that we are going to be discussing on the syllabus. Alright, so as I said earlier, 5 questions, no options. You answer all 3 hours, 50 minutes reading times. Ratio of theories to practical can be between 75, 70, 25, 75 calculations, 25 theories, or 80-20 depending on the discretion of the examiner. Most of the things you'll be doing may be in relation to calculation, so you've got to prepare and understand the principle. Let me also start off by saying that financial management is not a difficult subject. Many people think that financial management contains a lot of principles, a lot of concepts, a lot of things, but to me, I know that financial management is not difficult. The reason is not being that I am the lecturer of the subject, but it is because of how the subject is. The subject must be learned in a certain order. So if you learn the subject in that order, then it will help you not to only learn it, but you will be able to put the pieces together and prepare yourself adequately for the exams. So these are the 5 things, or these are the 3 major sessions we will be running in this series, and it is our objective to finish with that and help you to become the chartered accountant, and we see you or wait for you at the top there. So let's begin our journey with the overview or the introduction. So overview of financial management. Overview of financial management. So this is the first series of this is the first in the 3 series we'll be running. This overview is very crucial to the entire series that we'll be running, because everything else we will be doing from here will depend on the overview that I'm putting up here. So I bid that you focus on it, read on it, listen to it, watch this video over and over again, and that will help you to excel in your examination as well as in the work field. So when we say overview of financial management, we are just, the objective of this series, as I've said, or this particular session, as I said, is just to introduce you to the entire 4 functions of the financial manager, and then give you a gist of each of the 4 functions, so that when we begin to take them one after the other, it begins to make more sense to you later on as we proceed. Alright, so what is financial management? In a simple language, financial management simply refers to the management of the finance of an organization in order to achieve the objectives of the organization. So the management of finance of an organization in order to achieve the objective of the objective of the organization is what refers to as financial management. Now, what are the objectives of the organization? Mainly, for a profit-making organization, the objective is to maximize the returns of shareholders, or maximize the wealth of shareholders. That is the main objective of not profit-making organization. So they will have to make more profits so that they can maximize the wealth of shareholders. But if it is a non-profit organization, then their objective is not to maximize shareholders' wealth, but rather to maximize the satisfaction that beneficiaries give and to maximize what we call value for money. So, objective of the profit-making organization is very different from the objective of a non-profit making organization. So, the financial manager's role in a profit-making organization is crucial, because in a profit-making organization, they are what we call financial objective and then non-financial objective. The financial objective are the objective which must be attained in order to achieve the main objective of the organization for the maximization of the wealth of shareholders. For example, a management can set objective for the profit, so profitability objective, financial objective, gearing objective. They can have some gearing targets that at the end of the year, we don't want to have a gearing above 50%, above 60%. That can be a target, a financial target that the organization set. Another thing will be in relation to the earning per share, the dividend per share, the earning yield, the price earning ratio, the gross margin ratio, the returns on capital employed. All these things are referred to as the financial objective of the organization. However, non-financial objectives are also much crucial to financial objective. Why are we saying this? Because the non-financial objective, when met well, will be able to achieve or will help the organization to achieve the financial objective. So what does that mean? Some of the non-financial objectives will include the welfare of employees, the welfare of management, satisfaction of our customers, undertaking corporate social responsibilities, paying our creditors on time, and then rendering after-sales services to our customers. These are some examples of non-financial objectives. Now, you must understand that when we are undertaking non-financial objectives, we are using shareholders' money to do that. However, what you must understand is that if our employees are not satisfied, if our management is not satisfied, if the customers are not satisfied, if we don't have goodwill with our suppliers or our creditors, then it means that we as an organization will not be able to achieve our financial objective. So, in as much as the financial objective is crucial, the non-financial objective is also very essential. So, this is what we call the conflict of interest that the financial manager faces. It's a difficulty the financial manager faces, because how do I satisfy customers at the expense of using shareholders' fund? How do I satisfy employees at the expense of using shareholders' fund? How do I give shareholders a lot of money if I have to at the same time give employees a lot of money? So it's sort of a battle, a conflict that the financial manager always undertakes. But the objective of the financial manager, or the goal of the financial manager, is to find a balance between these two. Because if an organization undertakes corporate social responsibility, in the long term, it will add up to the market share of the company, it will give goodwill to the company, it will increase the profitability of the company. If the company pays its employees good salary, provide them with good working environment, it will bring in good morale to the employees, motivate the employees so that they can give up their best to the organization. So the financial manager's objective is supposed to find the difference between these two and then strike a balance so that he will be able to achieve and satisfy everybody on the same level. Now, financial management is all about the functions of the financial manager, or the decisions of the financial manager. Basically, there are four major functions of the financial manager. You can talk about any other things, but there are four major decisions of the financial manager, and that is what this syllabus is premised on. The financial management syllabus is premised on these four decisions that the financial manager makes. What are these four decisions? What are these four decisions? The first decision is called the investment decision. The second is called a financing decision. The third is called the dividend decision. And the fourth is called the risk management decision. So these are the 4 decisions that the financial manager makes. The 4 decisions that the financial manager makes. And in this session of the video, we are going to try as much as possible and go through these and see how best we can excel in that. When we say investment decisions, what do we mean? Investment decisions are decisions that relates to either the acquisition of an asset or the day-to-day running of the business. What does that mean? It means that when it comes to investment decision, we have what we call the capital investment and then revenue investment. What does that mean? We have capital expenditure and then revenue expenditure. So businesses can invest in the long term, that is buying plants for the business, buying vehicle for the business, undertaking projects for the business, acquiring some subsidiary. All these are investment decisions, and they are in the long term, and they are capital investment decisions. But in the day-to-day running of their company too, the organization must decide how much cash do we want to keep on ourselves for transactional purposes, for speculative purposes, and for risk or emergency purposes. Then the organization has to decide how much inventory must we keep as an organization. What is the level of debt that we can handle in the short term? What is the level of credit we can give to our customers in the short term? These are in relation to what we call the short-term investment of the company. And under the investment decision, that is where we have what we call the investment appraisal, 2 topics here, and what we call the working capital management. So investment appraisal and then the working capital management. So capital expenditure, that is a long-term expenditure, will relate to how the business is going to acquire a subsidiary, launch a new product, buy a machine, buy a new vehicle, or undertake a certain long-term project by the organization. With that decision, we will assess it using what we call the investment appraisal, so that we will assess whether the project is worth to be undertaken or not worth to be undertaken. We will look at that in a moment. Then, working capital management has to do with the revenue investment decisions, where we are making investment in relation to the short and medium term of the organization, that is working capital. How much debt do we keep? How much inventory do we keep? How much credit can we keep? And then how much cash can we keep? So these 4 elements put together gives us the working capital of the organization. Current assets minus current liability give us the working capital of the organization. So how much of these working capitals must we keep? The financial manager must decide and make that decision based on certain indicators. Now, we're going to be doing investment appraisal later on, but let me throw some light on that quickly, as this is an introductory video. In an investment appraisal where the project is a long-term project, taking 5 years, taking 10 years, taking 20 years, then we would have to now assess how the project, whether the project is worthy to be taken or not worthy to be taken. So there, the organization has to decide in relation to whether the project is acceptable or not acceptable. In taking that decision, the financial manager would have to appraise the project using the technique, as I said, called the investment appraisal. In the investment appraisal project, or in the organization investing in long-term projects, they have to undergo what we call the investment decision-making process. The investment decision-making process. There are 4 investment decision-making processes. The first one is called origination of the proposal. The second one is called project screening. The third one is called you analyze and you accept. And the fourth one is called monitoring and review. So what do we mean by origination of proposal? Every organization must create a system where on a regular basis, new proposal must be on the table. New ways of doing the things must be on the table. This can be undertaken, or this can be had by some institution where they invest more in research and development, so that they have a research department that is consistently researching about how we can produce a new product, how we can modify our existing product, and how we can satisfy customers on a large scale. So organizations must have systems in place so that they can be able to scan for new projects, scan for new proposals, and that the proposals are going to be presented for management, so that management will now decide which of the proposals to be undertaking. Now, after the proposals are originated, ideas are originated, and they are brought before management and before the financial manager, then we come to the second stage called project screening. You see, it is not all projects that are proposed that the organization can undertake, because the project must fit into the long-term strategic direction of the organization. The objective must fit into the mission of the organization. The objective must fit into the objective of the organization. The objective must fit into the vision of the organization. So in 5 years, in 10 years, what is the vision of the organization? What is the mission of the organization? What is the strategic plan of the organization? What is the marketing objective of the organization? All these factors must be taken into consideration at the screening stage of each project. So when the projects are brought, we can bring about 10 projects at the first stage. But screening, based on our strategic objective, based on our vision, based on our mission, based on our marketing strategy, based on our goals as a company, we may decide to screen down the projects, and we may have maybe 5 of the projects after the screening. That's the second stage. Then the third stage is the analysis and acceptance. This is where investment appraisal comes in. We have to now analyze the financial possibility of the project that has been proposed. All right, it fits into our long-term goal. It fits into our mission. It fits into our strategic plan. It fits into our strategic marketing plan. It fits into the objective of the company. All right, if it fits into the objective of the company, then what is the financial viability of the project? So that is the third stage we do. We analyze the financial viability of the project. Now, at this level, where we are doing investment appraisal, there are a lot of projects, or there are a lot of methods that we can use at this project or at this point. So let me rule a line here and let me go ahead. We can use what we call the payback period. 2, we can use what we call the discount factor. 3, we can use what we call the accounting rate of return. And 4, we can use what we call the internal rate of return. These are the 4 methods that we can use to appraise the project and see if it is acceptable to us or not. Normally, the payback period has to talk about how long it takes for the projects to pay for the capital that was invested in the project. So what does that mean? Normally the payback period is used where we have 2 or more projects, like how we have our scenario here, 5 projects. So if you have 5 projects and they are all projects that fit into the objective of the organization, then we may decide to undertake one of the projects. So if we are deciding to undertake one of the projects, then we will do what we call a payback period. Now, the payback period simply is how long is it going to take the project to pay for the capital that we invest into that project. So, for example, if we have a project and the life of the project is maybe 5 years, the cost of the project is, let's assume, to be $300,000. That's the cost, initial investment. And from year 1 to maybe year 5, we're going to be having, let's say, $40,000, $120,000, $800,000. That's too much, $80,000. Then let's say $60,000. Cannot be falling, let it be increasing. $130,000, $150,000, and then $50,000. So the project life, let's assume 6 years, 1, 2, 3, 4, 5, and the 6th year we have $120,000. How do we do the payback period? The payback period is simply where we settle. We put year here, we put cash flow here, then we put what we call cumulative cash flow here. Now we're going to invest 300,000, so we put that down. So still negative cumulatively 300,000. Then year 1, we're going to have 40,000. It's a cash inflow. When we subtract it from this, we get $260,000. Still negative. Year 2, we have 120,000. When we subtract it, we're going to have 140,000. Year 3 was 130,000. When we subtract it, we're going to have still $10,000. And then in year 4, it's 150,000. It means we will pay for the loan there. What does that mean? It means that it is going to take us between 3.5 years, between 3 and 4 years, so that we can be able to pay for the initial capital investment. That is what payback period is about. So you bring in the first cash outflow, then you will be bringing the inflows till you are going to get positive. So when we pay off this, we are now getting positive 140,000. It means that the payback period is between 3 and 4. Between 3 and 4. But you don't just say between 3 and 4. The technique is that you write down that payback period is equal to the 3 plus how much was left before we brought the 150. It was 10,000. So we put into brackets 10,000 over how much did we bring? 150,000 times 1 year. Right? So 3 years, let me do that well. So 3 years plus 10,000 over 150,000 times 1 year. And that should give us what? That should give us an answer. So that should give an answer. Let me slot in that into my calculator. 3 plus, bracket open, fraction, 10,000 divided by 150, bracket close. And that's giving us 3.07. So 3.07 years. So this is how long it's going to take the project to pay back for the initial investment. Is it good or not? We cannot make that decision because we are not given a prior knowledge of the business. Assuming the business has a standard that all projects that exceeds 4 years to pay back their initial investment will not be undertaken, then it means that this particular project, which will pay 3 and 0.7 years, we will accept the project. It means when it exceeds the 4 years, we won't accept. When it's below 4 years, we will accept. So that is what payback is about. But we can, as I said, we use it to do comparison between two major or two different projects. So you look at the analysis, then you take out, that is how or what the investment appraisal in relation to payback period is about. Now, aside payback period, we can use what we call the discount factor. This is where we try to find the present value of the future cash flows of the business, so that if it is positive, we accept the project. If it is negative, we reject the project. So with regards to using the net present value of the project, we just find the present value of the project and we ask ourselves, is it positive? If it is positive, we accept the project. If it is negative, we reject the project. Now, about net present value also, let me try to put down an illustration for us. A machine will cost $80,000. It has a life of 4 years with an anticipated scrap value of $10 or $10,000. Expected net operating cash inflows each year were as follows: 20,000, 30,000, 40,000, and then 10,000. Calculate the net present value of the investment and determine whether or not the project should be accepted. So we're going to have year here, we have cash flow here, we have the discount factor here, and we are told that the cost of capital of the company is 10%, and we have the present, we put the present value here. So this is in dollars, this is in dollars. Right? Now, first year, now it's 0. Now it's always 0. The initial investment of the project is $80,000. Always the now is 1.00, so we will still have negative $80,000. Then we are told that year 1, year 2, year 3, year 4. In year 1, we're going to have $20,000. Year 2, we will have $30,000. Year 3, we will have $40,000. And year 4, we will have $10,000. Now, what is the discount factor? We will read the discount factor on the discount table, and I have my table here. 10% year 1 will be 0.909, year 2 will be 0.826, year 3 will be 0.751, and year 4 will be 0.683. So these are the discount factors that we read in relation to that. Now, how did we get that? How did we get that? We got that by reading it from the present value table. We read that from the present value table. You can find the present value by using the formula 1 plus r exponent negative n. So 1 plus the rate that is given exponent, the period you are looking for, then you can calculate and get for those rates. Alright, so let me use my Casio and help me out. 20,000 times 0.09. I have 18,180. Then 30,000 times 0.826. I have 24780. Then 40,000 times 0.751. I have 30,040. Then finally 10,000 times 0.683. I have 6830. Then I get it. NPV. We have all the net present values. So we have negative 80,000 plus 18,180 plus 24,780 plus 30 and 40 plus 6830. What do we have? Negative 170. So the net present value of this project is minus. It's negative. So what do? We reject the project. We reject the project. So that is what net present value is about. We forgot something, because in year 5, we are told that at the end of the project, the scrap value is 10,000. We forgot that. So let's slot that in quickly. At the end of the project, scrap value. So still in year 4, at the end of the project, scrap value 10,000. That will also be discounted at the same amount. So that here will be 6830. Then we will have plus 6830. Then we have 6660. So it's a positive. What do? We accept the project. We forgot the scrap value in our working, so we bring it back, and now we have a positive NPV. It means we accept the project. This is what we call the present value analysis. So this is what we mean when we talk about the net present value. I hope it is clear. Then aside that, there is another method that we can use in investment appraisal. It's called the internal rate of return, which has the formula A plus NPVA over NPVA minus NPVB into bracket A, B minus A, bracket close, all bigger brackets, percent. What does that mean? The internal rate of return is, finding the effect of the reinvestment of the returns that come on, or the cash flow that we receive from the project. It means that the internal rate of return is the rate at which we are going to reinvest we reinvest the cash inflows that come as a result of the investment of the project. Alright, so the cash inflows that come, at what rate are we ready to reinvest it? That is what the internal rate of return is about. The decision rule is this: when the internal rate of return is greater than the cost of capital of the company, we accept the project. If the internal rate of return is less than cost of capital, we reject the project. That's the decision rule for the internal rate of return. If it is greater than the cost of capital, we accept the project. If it is less than the cost of capital, we reject the project. That is what internal rate of return is about in relation to that. Now, as I said, this is just an overview, so we will be dealing with the topics later on. There are various issues that you are supposed to be talking about later on as we proceed. Then the fourth method under investment appraisal is what we refer to as The fourth method is what we refer to as the accounting rate of return. The accounting rate of return. The accounting rate of return has to do with where the accounting rate of return. The accounting rate of return, as I said, has to do with where we look at the expected profitability of an investment, the expected profitability of an investment. So that one has the formula as the average profit per annum. The average profit from the investment per annum. Then we divide that with the average book value. Book value of the investment times 100%. The average book value times the 100%. So that is how accounting rate of return is also about, and we will look at that later on as we handle the topic investment appraisal. So the first decision that a financial manager makes will be in relation to investments in the long term. Investment in the long term. Now, one thing that is certain about the investment in the long term is a problem that a financial manager takes or encounters called capital rationing. Capital rationing has to do with the limited in supply of finance to undertake all positive or acceptable projects. What does that mean? It means that the organization has more positive or acceptable projects, but the funds are not available. If that happens, then we need to ration the capital. We need to use the capital to do a part of this and a part of that. Now, depending on the properties of the project, the organization can decide whether the projects are mutually inclusive or mutually exclusive. Mutually inclusive simply means that the projects are interdependent on each other. You can't do one and leave one. Mutually exclusive means all the projects are independent on their own and they are separate projects. You can do them separately on their own. So, capital rationing. Why would an organization decide to do that capital rationing, or why would the organization will encounter limited in supply of the finances that it has? Two of the reasons are what we call soft capital rationing, and then two, hard capital rationing. The soft capital rationing is about the internal limitations of finance. It's about the procedures that management have put in place or measures management have put in place that limits management to increase their capital so that they can undertake positive net present value projects. It can be, for example, the start of the year, the organization can decide the target for gearing. It means if the organization has reached that gearing target and it needs more finance and it can't get it from shareholders, then it can't go for an extra loan to come and finance net present positive or acceptable projects. Or better still, the organization has put in place how much money they want to spend in the accounting year under discussion. If they have hit that bottom, then it means that they cannot spend more money. It is called soft capital rationing. But hard capital rationing is as a result of external influence. Maybe the organization has undertake some agreements with some people which limits the organization to spend more money. So the organization can issue some loan stocks or can go for some loan in the bank, and in the agreement of the loan, they will say that until you pay for those loans, you cannot raise an extra loan. That is a hard capital rationing. So any other external influence that the organization faces in the raising of finance, that is what we refer to as hard capital rationing. Then also, we are listed on the stock exchange market, and we have a maximum amount of stock that we have to issue, loan stock we have to issue. And we have issued those loan stock and it's still not enough for our projects. Because of that external ceiling that has been placed upon us by the regulators of the stock exchange market, the organization cannot be able to raise enough capital. So even though we have positive net present value, we cannot undertake the projects that we want to undertake. So basically, in the long term, these are the things that we will be discussing under investment appraisal. So the financial manager's decision, the first one is about investment decision. Where do we invest? What projects do we undertake long term? How do we manage the day-to-day running of the business? How much inventory do we keep? How much debtors can we keep? How much cash, liquid cash can we keep? How much creditors can we keep? What is the net working capital, or what should be the net working capital of the company? These decisions are all referred to as investment decisions. The second decision is very crucial, called financing decision. The financing decision of the organization is in two ways. First, where do we get our money from? So, sources of finance. So, two topics here. Where do we get our money from? Sources of finance. And two, what is the cost of the finance, which we can call cost of capital. So, when it comes to financing decision, the financial manager is asking, where are the sources that we can get our finances from? And two, from all these sources, what are the cost of capital from all these sources? So that the financial manager will strike and find out the lowest in relation to financing. But in financing decision, we believe that the organization, or some writers believe that the organization follow what we call the pecking order theory. The pecking order theory. The pecking order theory says that if an organization wants to undertake any project, it must first fall on retained earnings. Alright, this is the capital that we have accumulated in excess for the past years. So we fall on that, or we come to debt finance. Or last one, equity finance. So this is what we call the pecking order theory. So many organizations, if they are looking for the sources of finance, they are looking for how to finance a project, they have to look at, all right, what is our reserve? Do we have enough reserves to undertake the project? If we don't have enough reserve, the next course of action will be debt finance before we can go to our shareholders. Now, why is debt preferred than equity? The reason is simple, because debt finance is tax deductible. That is one of the things. And two, that sometimes it is cheaper to raise debt than to raise equity. And it is faster, because if you go to the bank, you want a loan, your bankers know you already, you sign documents, and that is gone. But if you are going to now issue new shares, go to equity finance, that is going to take time and incurs a lot of cost. So the cost of raising debt finance is lower than the cost of raising equity finance, and debt finance is also tax deductible. It means that the interest that the company is paying, they will deduct it from the operations before they pay tax. But if they go for equity finance, the company is going to pay huge tax in relation to that, or in relation to the profit they are making. Before, after that, the profit that they left, they give it to the shareholders. So to avoid that thing, many companies follow the pecking order theories. If we don't have enough retained earnings, then we go for debt finance. If debt finance will not favor us, and the last result, we have to go to equity and then float new shares or do what we call rights issues. So what are the various sources of finance to companies? What are the various sources of finance to company? So sources of finance. If the company wants to finance projects, what are the various sources of finance to the company? We will have the first one called long-term, 2, short-term, and then 3, other sources. Now, in the long term, if the company wants to undertake a long-term project, a project that will take 5 years, a project that will take 10 years, a project that will take maybe 3 years, then the organization cannot finance that project using short-term source of finance, like bank overdraft. Then the company must finance that project using a long-term source of finance. So when it comes to the long-term source of finance, we can finance that from debts, that is loan, debentures, or loan stocks. That's a long-term source of finance. Or we can go to our shareholders and do or call equity source. With the equity, we can do what we call initial public offer, or what we call the rights issue. We can go to our existing shareholders and tell them that, listen, we want to undertake this project and so we need more money. So if we issue new shares to our existing shareholders, it is called rights issue. But if we don't issue new shares to our existing shareholders and we do a public issue and issue shares to the entire public to come and subscribe, that is also a long-term source of what? Finance. So we are saying that with the sources of finance, we can go by the long term, either from debt, either from what? Or equity. Now, sometimes the organization doesn't do full debt or full equity. So maybe we need $300 million. All right, they can decide to raise 100 million loan and then raise the 200 million from equity. Now, if the organization does a combine of that, we call it the hybrid finance. Hybrid source of finance, where we mix the two. A proportion of debt, a proportion of equity. Or sometimes we call it the mezzanine finance. So when we are comparing or combining a little debt, a little equity, not full debt, not full equity, then we are dealing with what? Mezzanine finance. So with that one, the financial manager in the business must decide the advantages and the disadvantages that are in relation to combining of the source of finance in achieving the objectives of the organization. So in the long term, when we are dealing with long-term projects, then we have to finance long-term projects using long-term sources of finance like long-term loan, debenture, loan stocks, or go to our shareholders or go to the stock exchange and issue more shares by public offer or by rights issues. In the short term, that is working capital management. Where do we get money to finance the working capital management? The day-to-day running of the company. What are the various sources of financing the short term? We can use bank overdraft. It's a source of finance. We can use trade credits, delaying the payments to be made to our creditors. So we are supposed to pay them on time though, but sometimes we can delay the credit so that we will use that money to sort out something else for the business to be able to do well, to be able to achieve our objective as a business. So we can do that. Bank loan, we can use what? Trade credits. And bank overdraft, I wrote bank finance. Bank overdraft. So bank overdraft, trade credit, or some short-term loan. There are short-term loans for 6 months, 3 months. So instead of taking bank overdraft, which you have to pay in 2 weeks, in a month, we can go for a 3-month short-term loan or a 6-month short-term loan, and we will pay it within that period of time. Now, to decide whether to go for a bank overdraft or a short-term loan will have to also depend on the objective of the company. Because with bank overdraft, it means that you are going to be paying a high interest on the amount. So you have $100,000 in your account, but you need $300,000. So the $200,000 in excess that the bank is giving you, you are going to pay an interest on that $200,000 that you are getting. But if it was a short-term loan, the interest you will pay on the short-term loan will be less than the interest you will pay on the bank overdraft. Then also with bank overdraft, it is easy that the company or the bank can just call you anytime to come and make the payments because we don't have time limit for it. But with a short-term loan, if you take the loan for 3 months, it means that in a way you are certain that before I will pay this money in 3 months or I'll pay this money in 6 months. But if it is a bank overdraft, at any point in time that finance hits your account, the bank quickly deducts that from your account. And so the organization must decide its objective and then what the organization wants to do. If what we need the money to undertake, it's a medium-term thing that will take like 3 months to 6 months to bring in returns, then we will finance that using maybe a short-term loan. But if we are using it to just make some short payments where we can get the money in few days or in few weeks, then we can undertake a bank overdraft. Then about trade credit. The fact that trade credit is a source of finance does not mean organizations should capitalize on it. So if you're a financial manager and you're advising your company that, hey, delay the payments you make to your creditors, remember, if you do that, you are losing goodwill, you cannot be trusted, and the next time they will not give you more credit. So you have to be careful about it so that maybe if they give you 30 days to pay, you know you are paying the amount in 30 days. You don't delay and pay the amount in 50 days. So that can be also a source of finance to the company. Then finally, other sources of finance. Other sources of finance may include certain things like either the company can go to a venture capital. So venture capital is a source of finance to the company. The company can also undertake what we call sale and leaseback. Sale and leaseback agreements, where the company wants money but doesn't have the money, so but it has some assets down. The company can sell the asset, but because they are using the asset to generate revenue, they can lease back the assets. Now, while selling the asset, revenue has come to the company. Company can now get finance to undertake some projects, but they have sold the assets though, but they have still leased back the assets so that they can use it to undertake projects, or go to a venture capitalist, where a venture capital company, where they can come in, finance the company, and then put in some money and become part owners of the company. Normally, venture capital companies want to be on the board of the company, and so they will influence the decisions of the company, but at the end of the day, still the company has control of itself. Then we can also, other source of finance can include what we call the Islamic finance. So we will deal with this later on as we go ahead. Islamic finance in relation to, it's a field that is growing up, you know. The Islamic world or Islamic religion don't know or don't want to agree with the word interest. They don't want to make profits, in quotes, on helping people in financial difficulties. As such, there are various models that we are going to look at in relation to that. We are going to look at Ijara, we are going to look at Musharaba, we are going to look at some of the models that we use there under Islamic finance, so that it helps you. It's also a source of finance to businesses. It's developing well in the UK now in the field of Islamic finance, and there are institutions running a whole degree, a whole masters in relation to Islamic finance. So the financial manager, these are some of the sources of finance to the financial manager. All right, so projects. We want to undertake projects. Is an investment appraisal or is an investment decision. All right. The project, if it is a long term, then we appraise the project using what we call the working capital, investment appraisal. If it's a short term project like the day-to-day running of the company, how much stock do we keep? How much debtors can we keep? How much cash do we keep? How much credits do we keep? That is a short term decision. That is working capital management. After taking the decision about how much we keep, we must look at where we get the money to undertake that investment project. And these are the sources of finance that we undertake. But in the financing decision, after we have looked at the various sources of finance, we have to now ask ourselves, what is the cost of the finance? What do we mean when we say cost of finance or cost of capital? Cost of capital simply means how much profit we must make in order to make or to pay for the interest or dividend on the providers of finance. What does that mean? If somebody provides with finance, you must give the person a return called the required rate of return. So what is the required rate of return that we, the company, must earn so that we can pay the shareholders or the bond holders or the debt holders their return that they are requesting from us? Now, to determine the cost of capital, we will look at that one also from three perspectives. So cost of capital or cost of finance. Three things. We will calculate cost of equity, which has the symbol K subscript E. Then we have cost of debt, which is KD. And we have the weighted average cost of capital, where the company combines the two. Now, what is cost of equity? Cost of equity is simply the required rate of return of equity shareholders. All right. So equity shareholders are giving us finance. What is their required rate of return? That is called the cost of equity. Now, cost of equity can be calculated using what we call KE equals D0 over P0. That is, D0 is the dividend, and then P0 is the market value of the shares. D0 over P0. So dividend over market value of the shares. Now, we use this formula when we assume that constant dividend is paid every year. So every year the organization pays $5. Every year the organization pays $5 a year. That is when we use this formula. But the thing is that in real sense, companies don't pay constant dividends over a year. However, when we assume that there is going to be a growth in dividend, then the formula becomes D0 out 1 plus G in over P0 plus G. So this is the formula if we are going to use the growth rate. The growth rate, I will explain this later on as we are looking at cost of capital in detail. But as I said, this is an overview, so we are throwing lights on it. So KE equals D0 plus G. The G here is the growth rate. That's the growth in the dividend. Maybe if a company has a growth in dividend for maybe 5% growth in dividend all the time, or 10% growth in dividend all the time. What does that mean? It means if this year we pay $10 per share, then if it is a 10% growth in dividend, then it means next year we are going to pay $11 per share. If it is 10% growth in dividend, then it means the next year we are going to pay 12.1% in the shares, and it goes in that order. That is how we calculate the cost of equity in relation to that. But there is a limitation to these formulas, because these formulas don't take into consideration risks. They don't take into consideration the time value of money. They don't take into consideration the returns on the entire market, or the risk-free, or the risk premium on investments. As such, sometimes these two formulas are not relied on, but we go for what we call the capital assets pricing model, which is the risk-free rate of return plus the equity beta of the company minus, into brackets, returns on the market minus the risk-free rate of return. So this is the capital asset pricing model, the risk-free rate plus the beta, returns on the market minus what? The risk-free rate. These two, that is the return on the market minus risk-free, is what we call the risk premium. The risk premium. What is risk-free rate of return? The risk-free rate of return is simply the returns we get on government bonds. So if government bonds can give us a return of 10%, and you want me to come and invest in your business, then your business has some risk, because when I invest in government bond, definitely I'm going to get my 10% back. There is no risk in it. So we assume government bonds like treasury bill, like bonds, like those ones are risk-free. So the government will still pay you your debt. But if I'm going to invest in a company, then there is a risk attached to the company. So the risk premium will be, what is the returns on the entire market? Maybe the returns on the entire market is 15%. So if the returns on the entire market is 15% and the risk-free rate is 10%, then it means that the required rate of return will now be what? 15%. So the difference between the returns on the market and the risk-free rate of return is the risk premium. That is the extra benefit I am going to get for investing in your company rather than investing with the government or buying treasury bill from the government. So these are the three formulas that we are going to be using when we want to calculate the cost of the source of finance that we are using. So if it is equity, constant dividend, we go by annual dividend over market value per share. If we believe that there will be constant growth in dividend, then we will do the second formula. But because these two formulas don't take into consideration risks, they don't take into consideration time value of money, they don't take into consideration relation to the returns on the entire market, we use the capital assets model. We use the capital asset pricing model. So these are how we deal with when it comes to the cost of equity. These are how we deal with when it comes to the cost of equity. Now we come to the cost of debt. Cost of debt. So let me rub my board and then we deal with that.